To me, the price itself, and I'm not avoiding the question, the price itself is far less important than the direction. And the direction to me over 6 months, 12 months, 24 months is definitely up. Yeah, well, I think we all know that the main driver of gold for the last 2 years has been central banks in an effort to diversify away from dollars in their reserves in the face of dollar weaponization. So we all know that's been the driver, and of course the central banks that have been buying gold, and as you mentioned, last year was another record high. December was very, very strong, so it seems to be accelerating. There's no pause. People were thinking there'd be a pause. But that has nothing to do with the strength of the dollar or the strength of the U.S. economy or whether interest rates are positive or negative on a real basis in the U.S. Or the jobs market or anything else. It has nothing to do with what's happening in the U.S. The sort of traditional drivers of gold, if you like, the macroeconomic drivers of gold is not what's been driving gold this time. And it's not just central banks, of course. Beginning of last year, we saw a big spike in Chinese consumer buying of gold in the face of a declining economy or fears of a declining economy in China, yuan depreciation, and of course concerns about the fragility of the banking system. So Chinese consumers moved into gold. But again, that has nothing to do with what I call the traditional macroeconomic drivers of gold. Well, to be honest with you, I've been thinking that we'd get a pause in this. Gold has been remarkably resilient. We did see that bit of a decline when it looked like, well, when President Trump was elected, it started, at the end of October, right before the election. So we saw a little bit of a decline. I honestly thought it was going to be a bit of a longer and deeper decline. But to me, it just shows that there is an awful lot of pent-up demand among central banks. I mentioned the Chinese, and also, of course, very wealthy individuals and families in the Middle East and in Asia in particular, but also in Europe, have been buying gold as protection against, let's say, the fragility of the financial system. With record debt everywhere you look, both at the government level and in many countries at the household level, the debt levels among governments are frankly unsustainable. And so I think people are buying gold as a protection against that. You alluded to it at the beginning, and I think, we'll get to it, I'm sure. But the one source of demand that isn't there right now is what I'll call ordinary retail investing in North America. That's just not in the market right now. My own feeling is that this is an interesting, certainly a very interesting story, but I think people are maybe making too much out of it. I don't think it's the beginning of the end of anything, or the end of the beginning of anything, frankly. You had US people move gold from holdings in London via Switzerland, because bars have to be refined to move to the US. You have people moving gold to the US ahead of tariffs, because, of course, if tariffs are imposed on Europe and the UK, even 10%, nobody's going to want to buy gold or import their gold when it's 10%. So people were moving ahead of that. And of course, as you mentioned, that's led to this divergence in prices. We've got a premium in US prices as much as $30 at one point, and $1 an ounce on silver at one point. And we're now getting a discount in London, right? So there is an arbitrage opportunity. But what happens with arbitrages normally? They work themselves out, as more and more people take advantage of that arbitrage. And just as we saw this move from London to the US during COVID, when people were afraid they simply wouldn't be able to ship gold, and now it's for other reasons, but they wouldn't be able, that unwound once the COVID panic was over. And I think this is going to unwind at some point once the tariff panic, if you like, is over. I think it's going to mean the gold price is going to stay high. I mean, there's a lot of drivers, and tariffs are just one of them. Tariffs are just one of them. So I think the gold price is going to stay high. The demand is remarkable. And as we mentioned, the regular North American investor, and by regular, I mean retail, I mean small institutions, I mean generalist funds, they're not simply in the gold market right now. They're not in the market at all. If you look at the GLD, which is the largest, the largest physical gold ETF in the US, one day in January had net inflows. Just one day had net inflows. We're going to talk about stocks later, but maybe I'll give you the, don't bury the lead. I'll give you the lead right now. The GDX and the GDXJ had 0 days of net inflows in January. I mean, this is astonishing. When the gold stocks are up 47% in the last year, and the major gold equity ETFs are not seeing inflows. Same goes for gold mutual funds, I can tell you. The ordinary investor is not moving into, not only are they not moving into gold, they're continuing to sell gold and gold stocks. Yeah, absolutely. I mean, let's first of all say, if you or I were Chinese in the Politburo, would we be wanting to sit with the majority of our reserves in US dollar at this point in time? I don't think so. We would be wanting to move away from that as rapidly as we could. And that's what's happening. And I think that's just going to continue to happen, frankly. And I don't want to get political here, but when President Trump threatens the BRICS with 100% tariffs, what's the reaction of countries? What's the reaction of Brazil or South Africa or Indonesia, let alone China? Do they say, oh my gosh, Mr. President, we're so sorry, we didn't really mean it. Forget it. We'll sell all that gold and we'll buy the dollar. Of course not. It's the opposite. In my view, it makes them, they might give concessions to the US to try to stave off the inevitable, but they're going to want to move away from a dependence on the dollar just as rapidly as they can, in my view. Oh, absolutely. Everybody thinks of gold as an inflation hedge. If you asked 100 people in the street, 99 would say gold's an inflation hedge. And that's because of recency bias. In the 1970s, gold was an inflation hedge. But throughout history, gold has acted, gold has acted better in deflations than in inflations. But gold is really a hedge against monetary chaos. And that can be inflation, or it can be deflation, or it can be recession. And in a recession, of course, people go to gold, and the statistics show this up. I don't have them off the top of my head, but in the last, 9 recessions since the 1960s, gold has gone up in about 7 out of 9. So gold has a very good track record of going up during recessions. And the reason gold goes up in recessions is because in a recession, you start to look ahead and say that the central banks are going to have to cut interest rates and ease monetary policy. And that's positive for gold. It's not the recession itself is good for gold. It's the response to a recession is good for gold. So I think we're definitely heading towards a stagflationary environment, in my view, and that will be positive for gold. We're almost there. It's funny. Just in Vancouver, you mentioned Vancouver 2 weeks ago. Someone said, "So, give me a target for gold this year. Do you think we'll break through 3,000?" I said, "That's not a very aggressive target right now." Oh gosh, to me, the price itself, and I'm not avoiding the question, the price itself is far less important than direction. And the direction to me over 6 months, 6 months, 12 months, 24 months is definitely up. So who was it? Someone, I forget who, said, if you want to know what the gold price is going to do, tell me what the dollar's going to do. And gold is moving up in the face of a strong dollar. So when the dollar turns, if the dollar turns, then gold could move just dramatically higher in terms of US prices. I don't know. I wouldn't be surprised at all to see, we might get some backwards and forwards at the 3,000 level. We often do. But the way gold is moving right now, I think we could easily just break right through it. And remember, if most of your buyers are non-US people, right? they're looking at gold priced in Australian dollars or Chinese yuan or Japanese yen. They're looking at gold in their own currency terms. And so 3,000 is not a magic number for them. So I wouldn't be at all surprised to see 3,500 to 4,000, that kind of range, within the next 12 months.